Hello, so today we'll be looking at the 2008 mortgage crisis. We'll be looking at what really transpired, what led to it, and how the government came into their rescue, how the government made things easier over the years. So, here are some articles we'll be going through, and that could actually put us through everything. So, we were told that for more than 80 years, the federal government has supported mortgage lending through a variety of policies, programs, and institutions. This support has helped enable millions of middle class and aspiring middle class families to buy homes. Despite the success, more conservatives continue to question the relevance and effectiveness of long-standing government housing policies. And over the past several years, conservatives who argue that some aspects of federal housing policies caused the financial crisis have pushed for legislation to eliminate or restrict government programs that make house ownership more affordable for Americans. This crisis have proposed dramatically narrowing the footprint of the Federal Housing Administration or FHA, eliminating the Community Reinvestment Act or CRA and scrapping the government sponsored enterprises or GSES. And we were also told that these conservative arguments should be treated with skepticism, right? The evidence shows that the usual targets of the conservative attack did not play a significant role in the housing and financial crisis. Government policies that make it more affordable to buy a house were not responsible for the crisis. In fact, consumers who already had mortgages and who had built up equity in their homes were more likely to be targeted by, you know, predatory subprime loans than first-time home buyers. So instead of too much government, it was the lack of sufficient government oversight in the key areas, including consumer protection, private label mortgage, securitization, bank capitalization, and financial markets that transformed, a housing bubble into a global financial crisis. So here are some federal policies to support house ownerships, right? The federal government enacted policies that the Great Depression that have over the decades help establish house ownership as a key pillar of the American middle class. After the mortgage market froze in the 1930s and banks were unwilling to enable to continue lending, the federal government intervened by bringing stability to the national housing market. So the government actually had to come in to help. And in 1934, Congress established the FHA, which offers government insurance on mortgages. The FHA protects banks against losses on, qualifying FHA insured loans, which makes banks more willing to offer mortgages to the public, particularly during tough economic times when they might otherwise close their doors. So now, we're also told that after the World War II, the GI Bill empowered the VA to insure mortgage loans to returning servicemen, providing government backing for millions of affordable mortgages that stimulated the country's economy's growth after the war. So, government support the mortgage market helped increase rates of house ownerships significantly between 1940 and 1960. The nation's home ownerships rate increased from 44% to 62%. So, owing both to robust government support of housing markets through the FHA and the VA through the GI Bill, as well as the strong demographic productivity and economic growth that characterized the, post-war boom. So now let's take a look at the way it was. And in 2013, according to an article, the home equity as share of household wealth by race actually. So the non-Hispanic white rated 57%, African American 69%, and other race and ethnicity 92%. And For generations, home ownership has represented the greatest source of wealth for most US households. You know, homeowners can draw on their housing wealth to invest in other activities, including supporting their children's education, getting financing for small businesses, or handling a financial emergency. You know, house ownership also allows households greater financial predictability and stability and has been linked with social benefits, including higher rates of life satisfaction, political participation, and volunteerism. So now let's take a look at some of the causes, right? We're actually told that there are a couple of main causes that really triggered this crisis, right? So we're told that hedge funds, banks, and insurance companies caused the subprime mortgage crisis. Head banks, Hedge funds and banks created mortgage-backed securities. The insurance companies covered them with credit default swaps. Demand for mortgage led to the asset bubble in housing. And let's take a look at some of the causes real quick. We're told that hedge funds played a key role in the crisis. So hedge funds are always under, tremendous pressure to outperform the market. They created demand for mortgage-backed securities by pairing them with guarantees called credit default swaps. What could go wrong? Nothing. Until the Fed started raising interest rates, those with adjustable rate mortgages couldn't make their higher payments. So that's the first. And the second was actually derivatives drove the supreme crisis. Banks and hedge funds made so much money selling mortgage backed securities. They soon created a huge demand for the underlying mortgages. That's what caused mortgage lenders to continually lower rates and standards for new borrowers. So that's a self-explanatory. We can get to see that when banks and hedge funds made so much money, selling mortgage bank securities, they soon created a huge demand for underlying mortgages. That's what caused mortgage lenders to continually lower rates. So when people start investing in housing and properties, and they're making so much money, people who really want to lend out houses would have to put their prices at a very very low rate, which happens actually up till now. And we can get to see the third reason actually was subprime and interest only mortgages don't mix. So, subprime borrowers are those who have poor credit histories and are therefore more likely to default. Lenders charge higher interest rates to provide more return for the greater risk, so that makes it too expensive for many subprime borrowers to make monthly payments. So the advent of interest-only loans helped to lower monthly payments to subprime borrowers couldn't. So subprime borrowers couldn't afford them, but it increased the risk of lenders because the initial rates usually reset after 1, 3, or 5 years. So there was actually a change after years. So the two myths about what caused the crisis, right? Fannie Mae and Freddie Mac were government-sponsored enterprises that participated in the mortgage crisis. They may have even made it worse, but they didn't cause it. Like many other banks, they got caught up in the practices that created it. Another myth is that Community Reinvestment Act created a crisis. That's because it pushed banks to lend more to poor neighborhoods. That was, that was its mandate when it was created in 1977. So another reason is actually collateralized debt obligations. The risk was not just confirmed to mortgages; all kinds of debt were repackaged and resold as collateralized debt, obligations. Another reason was actually downturn in real estate prices. Every boom has its burst, right? And in 2006, housing prices started to decline. Another cause is actually subprime mess spread to the banking industry. Another one is how a later accounting, rule made